I have $10,000 and I want to turn it into $1 million, right? Podcast called My First Million. I want to go from 10K to $1 million. So that's 100X or 100 bagger in your terms. What would you be advising me? How would you coach me to think about that? How would I take 10K and turn it into $1 million?
So I would make some tweaks to your thinking first about the 10K. So I would say, okay, the 10K is a good starting point, but what I also want you to do separately from that is have a day job.
Yeah.
Okay. And I want you to spend less than you're earning. And I want you to take the 10K, and I also want you to take your annual savings, maybe that's $5,000-10,000 a year or whatever it is. And normally I would say put it into an index, right? The index, like the S&P, is overheated. We can't go there right now. Circa 2025, we cannot go into the S&P. Okay, maybe 2035 we can, but not 2025. So what I would do is I would treat Berkshire Hathaway as the index because they have such a huge portion of the market cap in cash, and they're ready to,
right? What makes you say the S&P is overheated?
Well, I think that if you look at the Mag 7 in terms of just trailing PEs and all of that, it's way above the S&P long-term average. But even if you ignore the Mag 7, look at the 493 other stocks, they are also trading significantly higher than historic averages. So it isn't just that the tech portion or the large techs are, because those are exceptional businesses, they may well continue to do exceptionally even for a while. But the thing is that when the multiples become high, it becomes difficult. You hit a kind of a brick wall. And this isn't the first time. We've seen this story play out. So for example, in the year 2000, early 2000, there were 3 stocks that were over a 600 billion market cap. On the whole planet, there were only 3 stocks over 600 billion. They were Cisco Systems, Microsoft, and GE. And we know how that story ended. Cisco never saw that market cap again from 2000 till 2025. Company's done well, it's grown and all of that, but it was just too euphoric. And Microsoft has also done exceptionally well. But from 2000 to 2015, 15 years, zero returns. And it wasn't just zero returns. It went from a 600 billion market cap to a 200 billion market cap before coming back to 600. So it wasn't a pleasant ride. And if we look at GE, we don't need to talk about that. I mean, that just imploded. It never came back. So in general, investing in the largest market caps in a time of euphoria isn't a great recipe for success. Okay, I wouldn't want
There's no book on the wall that says.
I wouldn't want to be all in on the Mag 7 and say that's where I'm going to be. I think that may be pushing it. But I would say that compared to even the remaining 493, I would take Berkshire over the 493 in the S&P. So I would just say the default currently is you put it, dollar cost average into Berkshire Class B shares, right? And you keep doing that day in, day out. Now, the thing about investing is that opportunities are not going to show up just because you have the cash. Okay? There is a mismatch between when you're ready to make an investment versus when the opportunity is there.
Right.
So our plan A is just keep putting money into Berkshire. And if we did that, the math is really simple. Even if we were doing 10% a year, right? I mean, which I think is pretty reasonable for Berkshire. Rule of 72, we would double every 7 years. Life is all about doubles. Okay, so now if we are doubling every year and we went, let's say we are a 20-something guy with 10,000 and you go for 50 years or 49 years, it's 7 doubles. Okay, 7 doubles is 128. Okay, it's 128 times your money. I gave you more than 100x.
Right.
I gave you 128x in 49 years.
Without having to...
Without
genius.
Without doing anything, right? So this is just plan B,
right?
Where we put the 10,000 in, it becomes more than a million, 1.33 million with no taxes paid.
Right.
There's no dividend, there's no taxes, there's nothing. And we haven't even gone to plan A yet, right? This is just sitting there. Now, the other thing is that every once in a while, there'll be opportunities that show up. And what we're looking for is something that hits you in the head with like a 2x4. So the best investments are ones that make no sense. You cannot make sense of the numbers. It's too good to be true. It's just weird and all of those things. So when these kind of unusual things come together where things don't make sense,
right,
that's when we want to dive in.
Give me an example, either from a simple example, either from your own investing, a Buffett investment, some case study of an example of a great investment is one that doesn't make any sense. The numbers just seem wrong, to you in the moment.
I'll give you one example where it was a moneymaker for me, but I didn't make even 3% of the money I should have.
Okay.
It was given to me on a platter and I blew it. I still made money,
right?
But I want to explain how, usually the best ideas, when you finally figure them out, they're very simple. In the year, I think this was like around 2001 or 2002, I had encountered this shipping company called Frontline. And Frontline was a company that owned a fleet of about 75 VLCCs, very large crude carriers. These are giant ships that transport crude from like Saudi Arabia to the US, and they're just huge. The entire global fleet at that time was 300 ships, 300 VLCCs. 75 of them were owned by Frontline, 25% of the market. The guy who ran and was the founder of Frontline, John Fredrickson, had put the entire fleet on the spot market. So there are two ways he could have dealt with his fleet. He could have done time charters, kind of 1 year, 3 year deals where he's guaranteed cash flows per day and all that, or be a gambler, put it on the spot market and play it.
Whatever the price today is,
right?
I'll take it.
So he had put it on the spot market, the entire fleet. Now these VLCCs, they have a cost with the cruise and all of that of around $15,000 per day to break even. That's the cost to break even. And at that time, we had like the Iraq war and different things going on. So oil demand fell a lot. And there wasn't enough need for VLCCs. So the shipping rates collapsed to the point they went to 7,000 per day. Okay, so now you have Frontline losing 8,000 per day times 75 ships. Right. Okay, and they're levered. Okay, and so basically the stock got taken out back and shot. Okay, like a 90% drop. Okay, and most of it was valid because basically, when we are making investments or when equity markets look at a company, they want to see consistency of cash flows. They reward consistency of cash flows. Here, what we were seeing is consistency of losses. Okay. No one could tell you when these losses will abate. So the dynamics were the stock, I think, was down to like $3 per share. And when I looked at it, I noticed two things. Okay. The first thing I noticed is all their debt was non-recourse. Their debt was tied to individual ships. There was no debt at the parent. So basically, if they defaulted on the debt of a ship, the bank could just take the ship. They couldn't really take the company, could just take that ship. They take a car loan. And the second thing I noticed was that there's a very somewhat liquid market to buy and sell these ships. So even when the rates went to 7,000 per day, the ships had dropped in price by something like maybe a third. 25-30% drop from where they used to be.
Right.
So what I realized is that if Frontline got into a crunch where they were having cash problems, they could just sell 3 ships. If they sold 3 ships, paid off the debt, they'd have enough cash left over to keep sustaining operations for 6 to 9 months. They could sell 3 more ships after that. So I felt like there was really no way the company was a candidate for bankruptcy. And there was really no way. And the other thing is I could look at the entire company and say, okay, what if they sold all the ships? If they sold all the ships, paid off all the debt, you would end up with like $9 or $10 a share. You're at $3. So you make 3 times your money if they just liquidated the whole business, right? So there was the arbitrage between the price of the stock and the net price of the assets in a distress scenario. Right? So I said, okay, we really can't lose money here. and we're going to go buy Frontline. So I put 10% of my fund into Frontline, right? Because I just couldn't see a way that we could lose money. Now, when these rates were at 7,000, what happens is scrapping of ships skyrockets. So there are these Greek ship owners who have like 1 or 2 VLCCs. They're like 25, 30-year-old rust buckets. Yeah. So they send them to Bangladesh or India to be broken up, sold for scrap, get 10, 15 million out, and go do something else with the money, right? Because the old ships stop getting rented because they're single hull. Right. After Exxon Valdez, everyone wants double hull ships. So when the market basically goes weak, everyone wants to rent the double hull ship because the prices are about the same. Right. So all the single hull ships are getting scrapped. So now the fleet went from 300 ships to about 250 ships. After a few months, the rates start improving. The oil demand starts coming back up. The rates go to 15,000. Then they go to 20,000. The stock's at $10. Okay. I sell my shares. Well done, Mohnish. Okay.
Tripled my money.
Yeah. In like 8 months or something. Okay. And I said, okay, this was exactly what I thought, right? Rates then go to 300,000 a day. Okay. At 300,000 a day, they're making something like 285,000 a day times 75 ships. Okay. That number is like infinity. Okay.
Yeah, I was trying to do the math.
Just assume it's infinity. The stock goes up in the next 3 years, 80x.
Oh, wow.
Okay. Here's stupid Mohnish, okay, patting himself on the back with the double. And I didn't even get a double. I got like 80% return on my money, and that was that. And so that was an example of where I did first order thinking, but I did not do second order thinking. So the second order thinking was, Buffett always says that the most important question to ask in investing is, and then what? Whatever you think, then you say, and then what? And you keep asking that, and then what? If I had been so smart as to ask the question, and then what? So you see that rates are terrible. You see the scrapping. You see that fleet's going to shrink. So even if oil demand doesn't come back the way it was, it's going to come into balance. Eventually, those losses are going to go away. And then you do the next thing on then what, which is that when oil demand comes back, it takes 3 to 4 years to build one of these things. So when the rates went to 30,000 or 50,000, and all these guys can see this is a great business now. Well, when you go to the Korean shipyards, who are now inundated with orders, they're going to say, go to the back of the queue. I'll give you a ship in 5 years. And by the way, the ship is no longer 70 million. The new price is 120.
Right.
Okay. Because I got more orders than I can handle. Right. So we had this dynamic, if I had thought about it, that once the demand became tight, you really couldn't increase supply for at least 3 or 4 years. So what's 285,000 times 75 times 1,000 days? That's the minimum number of time when that price is not going to come down. It's only after 3 or 4 years, more ships start getting delivered and you start getting more balance and all of that. But that's an insane amount of cash flow, right? So the thing is that there are always, like, our friend Jim Cramer says, there's always a bull market somewhere. Okay. So basically, if we are plan A, Berkshire Hathaway, plan B, looking for anomalies, right? Every so often, not very often, every so often, you will find something weird. And we've got all the time in the world. We can research something for 3 months. It turns out it's not that great. Let it go.
Right.
We got Berkshire still cranking. Okay. So if you look at Warren Buffett, in his 2022 letter, he said that in 58 years of running Berkshire, there have been 12 decisions that have moved the needle for Berkshire stock. Now, in 58 years, he made more than 300 or 400 purchase decisions for stocks and businesses. Okay? Out of 300, if I take a conservative number, it's actually more than that, only 12 were exceptional. And he said there was one good idea on average every 5 years. Okay? This is Warren Buffett.
Right.
With a 4% hit rate. Okay. So basically, great investment ideas are rare. We're not going to run into them every week or every month or every year. So plan A, stick it in the index. Plan B, keep running a Geiger counter over everything, looking at different things. And when something doesn't make sense, drill down, and every so often, you're going to hit a mother lode.
Right.
And when you find something that's a mother lode, you peel off 10, 15% of what you have in Berkshire, put it into that, let it play out, then put it back into Berkshire.
Right.
Right. And just you keep doing that. And now your 100x is going to show up in half the time or less.